Welcome to The Explainer. Today, we're talking about something we all think we know, our salary. But here's the thing, we're not talking about the number on your offer letter. We're talking about the number the tax authorities see. And as you're about to find out, those two things can be very, very different. So let's start with the big question. What does the tax law actually count as your salary? Because, spoiler alert, it's a whole lot more than just the money that lands in your bank account each month. The official definition is way broader. So first things first, let's decode what salary even means in the eyes of the law. We have to start with the official definition because everything else, all the perks, all the exemptions, it all builds on this one core idea.
The first thing to get your head around is that salary, for tax purposes, is like a giant bucket. Of course, your basic pay gets thrown in there, but so do your wages, any pension you receive, gratuity, fees, and commissions. Even an advance on your salary or the cash you get for unused vacation days that's called leave encashment, yep, it all goes into the same big bucket. And it gets even more interesting. Where the money comes from really matters. See, if you get some back pay from a former employer, that still counts as salary. Bonus or commission? Absolutely, that's in. But here's a huge distinction you can see on the right. If you're a partner in a firm, the money you take out is not considered salary. Nope, it's treated as business income. And that's a whole different ballgame with totally different tax rules.
Okay, so we've covered the direct cash payments, but that's not the whole story. The tax authorities are also super interested in all the non-cash benefits you get. These are kind of the hidden components that can seriously bump up your taxable income. And that brings us to this key term, perquisites. You've probably heard them called perks. The idea is actually pretty simple. If your employer gives you any benefit that isn't cash but has a real monetary value, something you'd otherwise have to pay for yourself, then that value gets added right on top of your salary for tax purposes.
So what does this actually look like? Well, a classic example is if your company gives you rent-free housing. The law figures out what that's worth and adds it to your income. Another big one? When your employer pays a bill that was really yours to pay, maybe your kid's school fees or a club membership. Even the premiums your company pays for your life insurance policy can count. It's a pretty wide net, and it's all designed to capture the full value of what you're being compensated.
All right, so we've spent all this time adding things into the salary bucket. Now for the good part, the subtractions. See, the tax code isn't just about piling things on. It also gives you specific exemptions that can actually lower your final tax bill. And this, right here, is where things get strategic. An exemption is an amount of money that, even though you received it, is legally not subject to tax. Think of it as a little carve-out. The government has decided to exclude certain payments from tax, and knowing what these are is absolutely key to managing your finances smartly.
Let's take a real-world example, cashing out your unused leave when you retire. For non-government employees, it's not a simple tax-free windfall. You have to do a very specific four-step calculation. You figure out 4 different numbers: the actual value of your leave, your average salary, a specific limit set by the government, and of course the actual cash you got from your boss. And here's the catch. The law is always conservative. It says you can only exempt the lowest of those 4 amounts.
And that brings us to our final piece of the puzzle, limits. These exemptions are fantastic, but they're not a free-for-all. Many of them come with various specific monetary caps or thresholds, and you absolutely have to know what they are.
This table gives us a fantastic snapshot. Look at a voluntary retirement scheme, or VRS. Your exemption is capped at 5 lakh rupees, or whatever you actually received if that's less. And notice the huge difference for leave salary. If you're a government employee, hey, the whole amount is exempt. But for everybody else, you're right back to that tricky 4-part calculation we just talked about.
Let's just focus on this number for a second, 5 lakh rupees. For that voluntary retirement scheme, this is a lifetime exemption limit. That's right. It's not per job, it's for your entire working career. Once you've used up that 5 lakh exemption, that's it. It's done.
And that idea of a lifetime limit is so important. As the law itself says, the aggregate amount is capped. What does that mean in plain English? It means these things are cumulative. The tax authorities are keeping track. If you get benefits from multiple employers over the years, the exemption doesn't just reset to 0 each time.
So after all that, after breaking down the broad definition of salary, uncovering all the hidden perks, and then digging into the crucial exemptions and their limits, let's end with this thought. Does that pay slip you get every month really tell the full story of your taxable income? As we've seen, the answer is almost certainly no. Your true taxable income isn't just a number you're given. It's a calculation you need to understand. Thanks for joining us on The Explainer.